Hi there, welcome to Funding by Alex. Today I would like to talk to you about leverage buyouts, or LBOs as they're commonly known. So let's start with the subtle difference between private equity and venture capital. In essence, private equity are more seasoned investors. They also take on bigger deals. It's more about extracting value than to take a risk and bet on possible winner in the future. If you look at private equity, normally these deals start at like somewhere between 15 to 25 million dollars and up, and venture capital is up to that amount. It's not uncommon for venture capital to go beyond that or private equity to go below that, but I mean that's more or less the benchmark. So private equity is more for bigger deals. So they take established companies, they extract the value, they leverage the company with an LBO. Basically, an LBO is quite a commonplace. So the only thing in private equity, but in essence, leverage buyouts mean that they pay down a little bit and they borrow the rest and make the company that they target responsible for the debt. So why are investors actually keen to get into private equity? So just to get where the money comes from. There's a lot of pension funds, sovereign wealth funds, family offices, endowments also that are used to power these private equity companies. So in essence, investors are looking for superior returns. If you look at the stock market, you're getting 7-8% maybe, and private equity starts at 8% basically, and goes up a lot. It's something that investors are looking for superior returns. So they're looking also either deal by deal, or they are looking at locking up their capital for a longer period of time. And the private equity fund normally applies the 220 ratio, which is 2% is the management fee for the people who run the private equity fund, and 20 is what they basically call like after the hurdle rate of, let's say, 8%. If they have at least 8% returns, that they get a so-called carried interest of 20%. For everything above that. So basically everything, all the returns above that, so it can be quite profitable for you to get into private equity, for private equity companies to do all these deals. You have to be probably a bit more ruthless than venture capital. Venture capital goes from pre-seed, seed funding to investing in rounds, priced rounds basically, where private equity is really looking at seasoned companies and how to extract cash flows. They're not really looking at the story; they're more looking at the management and the quality of the management. This also, is a category of private equity companies. I'm not saying that all of them do it. Obviously, as you have everywhere, there are people who are a little bit more ruthless than others. Where the term corporate raiders come into play, where they are preying on companies, loading them with debt, and then eventually betting on whether or not they'll make it. So, what is an LBO in essence? So, just to get to the nitty gritty of this, an LBO is a leverage buyout. So, in essence, you identify a company. I'll go into the steps later, but you identify a company that you would like to buy, but you don't have the cash. So basically, that's what private equity companies do. They pay down maybe 20% and they borrow 80% of it, which is the leverage part. So in essence, leveraging it with debt. They are not responsible for repaying the debt. They actually use the assets and the cash flows, the free cash flows of the target company to pay the debt. So eventually, that's the guarantee or the collateral of the debt. So there are borrowers who are working with private equity companies and do that. So this is where the value creation comes into play. I'll explain it in more detail later. Debt plays a very important role in LBOs. So if they would pay down 100%, there would not be, not be any fun in it. Debt is actually where, if you only pay down 20%, you basically finance the rest with debt. So as soon as you repay the debt, the company increases in value. Therefore, your investment increases in value. That's why private equity, on paper at least, can come up with the superior returns I just mentioned. So what are viable targets for LBOs? Now, not every company is able to do this. There is, in essence, size is not the biggest issue. But if you look at it has to have a strong asset base. It has to have free cash flows. And it has to have a very strong management team. So, and above all, the industry has to be mature. So if you look at it, can be fragmented. So if you look at fragmented industries where LBOs can lead to one company getting their hands on a lot of cash, and then under the pressure of actually performing, because they need to grow, they're looking to consolidate these industries. There's a lot of examples where LBOs are used to gobble up a lot of smaller competitors and then create a very large platform. So in LBO and private equity language, it's called like bolt-ons, tuck-ins, and all those things basically. um, it's all about value creation and enhancement. So in essence, they are looking at creating a lot of value through superior management quality. So the management they retain is top notch. They are, in essence, what I would like to say, because you can't be an expert in that company, if in essence in every industry, but it's about cutting costs and making the company more efficient. In essence, yeah, sometimes getting out of certain sectors, cutting down the product line to the bare essentials, cutting jobs in some cases. So it's not all, green grass, blue sky. It's actually quite tough decisions these people make. And last but not least, it doesn't always end well. So sometimes there are companies. I've been involved in a couple of companies where there was, an LBO involved. I was about to join a company many years ago that just has had been acquired through an LBO. They had been stacked with debt, was it backbreaking debt basically, and in the end they couldn't make it because they couldn't grow the business. They just were stuck at a certain point, and yeah, in essence, that didn't end well because the company went bankrupt, and all my friends who worked there, they lost their job in the end. And one illusion poorer, I guess they went through through the world. But I mean, one experience richer, yeah, because that's something, okay, that's once and never again. So it can be very nice. It can be very rewarding because these people who do this, of course, they get rewarded very well. So you don't do it for free. You actually get quite a good stake in the company, skin in the game, and you get a decent salary for the purpose of helping the PE fund to create value. But like I said, there are a lot of horror stories of companies that have been acquired and then had to declare bankruptcy because they couldn't make it. So uh, just to emphasize also that there is a downside to this entire thing. So just to stack the LBO requirements. So first you need stable cash flow. Stable cash flow is needed to repay the debt that is going to inevitably be loaded onto the company. Then you have low existing debt. So of course, if you have a lot of debt, you can't take on more debt. So this affects basically stable cash flow. Then tangible assets. So there's a lot of assets that could be collateralized for bank loans, etc. Then you have to have a very strong management team, a team that really has the experience to identify the opportunities in the market, the threats in the market, and knows how to capitalize on them. Then there's, of course, there has to be a lot of growth potential. So if you are looking at a company that still has a lot of room to grow by introducing new products, by accessing new markets, by maybe acquiring new competitors, for a lot of competitors, basically. Yeah, that is the growth potential. Usually, that's the bolt-on, the M&A type of part of the game that is put into play. So M&A is the way to grow, growth potential, meaning fragmented markets are better, but market should also be less. But maybe the industry should be less. This industry characteristics should be less prone to economic downturn. Basically, should be more stable sectors that they are. So not stuff that is really up and down. So that's basically in a nutshell the LBO requirements. So the companies that are identified by private equity to be viable for an LBO are these companies. A variation on this is an MBO. MBO is a management buyout that is also usually assisted by a similar thing, but we're not going into that today. Then step by step, we go through the process. So you have deal flow. So usually these deals can come from various sources. They can be consultants, they can be brokers, they can be their own team, they can be networking events, they can be investment banks that come up with deals. So usually private equity funds have a trusted network of advisors where they say, okay, hey, look at this company, look at that company. So they can make an offer to any company, unsolicited or solicited offer. So if you, as a private equity fund, would like to acquire company A, you can simply extend an offer. So there is no reason to not. There's no protocol or procedure that prohibits you from doing so. The second point is actually where you structure the deal. So this is all down to how much equity are you investing, how much debt are you going to take on, and of course the valuation, how much is the company worth, how much are you going to pay for it. So this is basically the technical side of the deal, so structuring it. Then the actual acquisition and ownership transition, so where the company, the private equity fund, actually takes control, 100% control of the company. So in the end, the management retains a little bit of the shares as skin in the game, but of course the entire decision-making process is with the private equity fund. It doesn't mean that the private equity people are looking to manage the company day to day and micromanage everything. So they will have an influence on various larger decisions, and of course the management is still beholden to them basically. Just that the day-to-day management, of course, is under the management of the company. Then what they will do is operational improvements and streamlining. Streamlining means basically like, you fire people, you get rid of certain business units that are not performing, you are trying to increase or apply certain management techniques, operational improvements, business process improvement basically. And usually this is just a fancy word for like, we fire half of the workforce and we outsource it to China or whatever basically. So, but I mean, a lot of genuine improvements can actually happen where the company is really improving its management. So this usually makes the culture of the company a little bit more, this is all about business, not so much about the fun anymore type of thing. So there are a lot of horror stories there as well. But yeah, in the end, it's a business. If you look at the value they need to, and they paid money for it, so they need to extract the value again. Then the debt repayment. So as soon as the debt goes down, the valuation goes up. So that's actually the quite interesting part of this. So you start with maybe 20% equity, 80% debt, and as soon as the debt is paid up, you slowly pay up the debt, then the valuation goes up because the company's value in general goes up basically. So in the end, this is an interesting metric to look at. We'll go into metrics in a moment. I'll explain in more detail. Then, of course, an exit strategy. So exit strategies can be basically three major ones. This is trade sale. So trade sale can be either as a smaller private equity fund, you build up a company from here to here, and then it's on the radar of an even larger private equity fund that is going to use that as an acquisition for an even larger platform. But it can also be a strategic sale. So in the end, trade sales and strategic sales are actually quite common for both, basically, where you say like it's a company in the same industry that is buying this company. Then refinancing, you are extracting value by refinancing, meaning it's the debt, you need to get the money out again. And then an IPO, which is going public, so you go to the stock exchange to get the value back. Then we go to LBO key metrics. So debt to equity ratio is basically how much debt versus equity. So how much money you borrowed versus the equity you put in. So how much cash they pay down versus cash invested versus what is borrowed from the bank. A higher debt to equity ratio, of course, implies that it's going to be more difficult for the company to make sound business decisions because they need to pay more debt, so to speak. They need to pay back with their free cash flows. Then IRR, internal rate of return. So normally the hurdle rate for private equity is somewhere between 20-30% at the minimum. Above 30 is even better, of course, but just to make it viable for investors to invest in private equity for that purpose. So a higher IRR means also the project is more viable for more interesting for investors and for private equity to get into. And you have a cash on cash multiple. So let's say you have invested a dollar, and at some point when you cash out, you get $3 back. Now that's a cash on cash multiple. So you basically how many dollars you get back for the dollars you invested. So that's the multiple you're looking at. It higher multiple obviously is makes it more attractive. And also again looking at the time value of money. That's the thing that is taken into consideration when it's the cash on cash multiple comes into play. So these are the key metrics for an LBO. So in the private equity world, they are using this to estimate whether something makes sense to do or not. That's why I said not every company is suitable for an LBO, and not every company is a suitable target for a private equity fund. Thank you for watching. I hope you enjoyed the video. If you did, please like and subscribe. If you want to send me an email, alex@goldendragoncapital.co. I'd love to hear from you. If you have any questions, I'd love to answer them. Thank you. Hope to see you in the next video. Bye-bye.